Hi, everyone. Welcome to YX Insights. This is Yimin. Today is April 25th. We are pre-market open. We're going to cover some macro updates first before going into SPY, QQQ, TLT, Bitcoin, and MAX7 stocks. So let's begin. So on the left, this is my daily dashboard where I record where our latest macro regime is. So the top half is the non-farm payrolls, inflation readings, with more current data around the GDP now by the Atlanta Fed, as well as true inflation. And in the middle section, we have the macro rates data across liquidity, the 10-year bond yields, and some of the bond spreads as well. And finally, we have yesterday's asset performance across bonds, energy, gold, Bitcoin, the equity indices, and the MAX7 stocks. So this snapshot every day should give us a good idea of the slow-moving factors that drive the economy, such as the unemployment rate and inflation, as well as the faster factors that drive the everyday stock market move, such as liquidity, yield spreads, and as well as the individual assets. So today, GDP now made a latest update for Q1 GDP at negative 2.5% annualized. So recession is typically 2 consecutive quarters of negative growth. It's pretty certain we've had the Q1 as a negative quarter already. So the question is whether Q2 would also be negative. So what's driving Q1 into the negative territory? 2 things mainly. First, the personal consumption spending has gone down due to the macro uncertainties. Consumers are worried about inflation, about their jobs, and therefore they're unwilling to splash on their spending. Then secondly, the net exports have gone down. So that means the imports have come up against the exports. Why is that? Businesses trying to generally front-run tariffs before they come into effect, because obviously with tariffs, things are more expensive, whether you pass on to consumers or not. So there has been a surge in imports in Q1, which essentially drove down the net export factor within the GDP calculation. So the question is this a one-off or is this going to be sustained because of the ongoing tariff uncertainty? And I think the biggest issue is the word uncertainty. So back in the 1930s, tariff levels were also pretty high, similar to today, but coming from probably a high base. But right now, the White House essentially splashed tariffs across the globe. And then a few days later, they said, no, we're going to pause it for 90 days to negotiate, except for China. And then they're saying we're having talks with China, and the Chinese are denying it, etc. It just feels that the White House can reverse policy stances very quickly without any warning, and that basically prevents businesses effectively plan for their spending, investments, hiring, and that essentially freezes the economy temporarily, at least until that certainty is removed. A second factor I've spotted recently is trueflation remains very low at 1.5%. And this is contrary to our popular belief that tariffs are inflationary. So tariffs on their own do raise the prices at one-off to a new level, which makes inflation higher because the businesses will at least pass on some of the cost onto the consumers by raising prices, unless there's really readily available homemade US products as substitutes. So it's not going to be 100% pass-through, but there will be pass-through. However, it seems that the negative growth impact of the tariffs uncertainty have kind of outweighed the inflation expectation from the tariffs themselves, so it's the second-order effect. Now that people are expecting deflation, people not spending anymore, and therefore the overall economy could be shrinking. And that could drive down price inflation or drive towards deflation instead. So it's very much a risk-off deflationary feel right now rather than stagflation, which is kind of what more of the headline suggestions from the Fed. At the same time, the Fed liquidity is tightening in the past few weeks. It has been on the rise since January, but just in the past few weeks, the Treasury General Balance Account has gone up. What that means is the Treasury has been issuing more debts or collecting tax receipts, and that money has gone from the bank reserves into the Fed reserve. So on the margin, that's negative for liquidity. It's not like on the day you will feel the yields going high, etc. But there is a slight lag. But you can, I suspect, in the near term, yields could go higher after the latest retrace, let's say. And finally, yesterday we saw the everything rally on Thursday: bond, gold, equities, oil, Bitcoin, everything closed higher. And I think that's the first time we've seen that in a long time. Usually, gold is the opposite of the other risk assets, etc. And I'm not really sure whether we're in a relief rally territory. At least I think we're at some crossroad. Potentially, we could be getting onto a more bullish path from here because of the technicals. But I think it's not 100% confirmed yet. So we're going to go through all of the price action one by one to see what's favorable and what's not. Another thing we need to think about is term premium for bonds. This is relevant for TLT. Term premium is the extra yields investors demand for holding longer duration bonds. And since the beginning of April, that has surged by more than 20 basis points before coming back slightly in the past week or so. So that has a positive impact on the overall yields you will see in the 10-year and the 30-year, etc. So that's something we need to bear in mind, whether this is a one-off spike and will come back down, or it's the start of a new sustained move up. And finally, we are looking at the FOMC path in the next 12 months. The market sees forecasts in the next 12 months between now and May next year. There are slightly more cuts pricing than the Fed's baseline projection in March. But the Fed did admit that they didn't shift the dot plot because they didn't really know where to shift it to, but not that they really believe in the two-cut scenario. So the market thinks this forecast, but it's not quite enough for a recession at pricing as well. So if you look at where we are now, 4.3%, and then 3.3% in 12 months' time, that is still pretty high compared to historical recessionary levels. In 2008 or in 2020, rates essentially got slashed to zero, right? And this 3.3% is 300 basis points above that recessionary scenario. That means the bond market doesn't really quite see the risk of a full-on recession where the Fed will cut rates all the way to zero. So that's also something to bear in mind because the market is underpricing the chance of a true recession. And that could mean that bond yields have lower to go on that sort of in that sort of scenario, as well as equities. So that's not been priced in yet. And definitely that is a risk we need to be aware of. Now getting on to our model signals for today. Tesla showed a signal of 1, yesterday was 0. So the question I get asked is, how often does the signal change? Because the day before yesterday, it was 1. And I've seen the back test, of course. There are days where the signal trends. It's a 1 for a couple of months between November and January. And then it was 0 for a couple of months between February and April. And then in between those days and between April to now, the signals change a lot. And I think when the market is kind of meandering sideways, the model is slightly weaker in predicting the day-to-day patterns, I would say. And also, in terms of success rate, the hit rate, it is 3% higher than if you did a buy and hold strategy. What does that mean? If the buy and hold strategy has when you buy and hold on a random day, the chance of positive return is, let's say, 50%, then the model improves that chance by 3 percentage points to 53%. It doesn't sound like a lot, but if you think about how casinos make money, they only need a 2% edge over the customer to for the returns to compound, right? So that's kind of what we're doing here. I would caution against any sort of model that will say 100% hit rate, etc. That's probably just really overfitted to the historical data and maybe not that useful with the unseen data going forward. So it's a balance between getting high Sharpe ratios and historical returns in your backtest versus having that model generating also reliably robust signals going forward. So these are the things we need to consider. And also in practical levels, not everyone can change their position every single day, and because the model doesn't account for tax implications or transaction costs. So these are the things that investors need to think about when they follow a model like this. For me, I use this model in combination to my technical chart analysis, evaluation, etc. We're using a full set of tools to try to get maximum returns or understand the market better, right? So I'm using a set of macro-related drivers to predict Tesla's stock returns the next day with a slightly improved success rate. It doesn't mean that the model will be 100% correct all the time, but it just teaches us in what set of scenarios Tesla has performed well historically, and in what set of scenarios Tesla hasn't. And I think that's very useful to know rather than just blind following the ones and zeros. Again, BTC, the signals has been won since our launch. And actually, the model has been pretty good in catching the latest rally from 79K to 93K today. Apple as well, signal has been won since our launch this week. And Apple has been on the rebound, so that's been pretty good. TLT, the model has been 0 for the past couple of days. Sorry, I had to change the update the TLT signal for the previous day. So that was a typo before. So yeah, the TLT signal is 0 for today and yesterday. But of course, yesterday it rallied slightly. It went up slightly. But I think the model is picking up the wider macro signals, thinking that the current scenario is not that bullish for TLT. So moving on to the next one, Google earnings. So we had Google earnings yesterday. To be honest, my read is that it's nothing exceptional. It's not bad. It's not great compared to what we had in Q4 either. The Q1 revenue rose by 12% to 90 billion, basically the same as Q4. EPS went up higher, so profitability improved by 49% year over year to 2.8%. Cloud revenue rose by 28% year over year, similar to Q4 really. Q4 was 30%. CapEx was up 43% year over year to 17 billion. So that's even bigger than Q4's 14 billion. So that's pretty big. And obviously these all AI, data center, etc. related, mostly. So Google is still spending a lot. The biggest issue for investors is that Google is spending a lot of money on the CapEx, but we have not seen effective monetization that can accelerate the revenue growth so far. So it's not been that impressive for the investors, I guess, to say, because the Google is spending a lot of money. When can we get returns back or revenue acceleration? Is this AI stuff really just trying to do an arms race without any sort of returns for its own sake? So that's what investors are gonna be thinking about in the next few quarters. So 2025 is going to be this sort of year where the returns, we've spent a lot of money, the returns haven't come back. How do we value the stock? All right, let's now move on to technical analysis. So I'm just going to move with SPY. My concern up to this point has been that SPY has been moving under this trend line from the February high. So I think until we break above this trend line, as well as above the Wednesday, April 9th high, we can't really decisively say we are in a bullish trend and we've bottomed on the 7th. And of course, I don't short the stock, so with like everyone else, I do wish the stock market to go up. But in the near term, I do think there is a lot of resistance for us getting through this trend line, this April 9th high, and there's a lot of volume traded in this region here. So in this area in March, around 550 to 570 region, people who bought the dip here thinking we have bottomed, only to find out the market broke down really aggressively in the first week of April, and they're backholding, right? So a lot of people have suffered a lot of pain buying in this region, and they didn't really get out over here. Now is the time to get out at break even, essentially, or a very small loss. So that's going to be the psychology going forward. Breaking above this region will be pivotal, above the 200 EMA, and then we could say, okay, maybe we have bottom here, and this is 1, 2, or we've got wave 3 that could go up to 607, and that could happen before the summer, right? So the next few weeks will be pivotal on how this, whether we get a bullish trend back, essentially. And the more you look at it, you could see that maybe we get here and we get a little retrace, and you have the head and shoulders here and the neckline around the 200 EMA and all that stuff. And then once it breaks above 600, up we go. So that's kind of things we're looking for right now. QQQ, very similar. We broke above this trend line, which is great. We are still slightly below the April 9th high. The market will open just below that as well. But it does look a bit more promising, essentially, than SPY. Again, we still have this heavy volume in this region that was traded in late March between 470 and actually all the way to 490. So this region here will be an area of significant selling, I would expect, from people who have bought down here. So breaking above, obviously, the 200 EMA would be very bullish, and then we could be potentially eyeing 520, 530 level for this wave 3. Now, looking at the 30-year yield, the reason we look at the 30-year yield is because it's more relevant for TLT than the 10-year. And what we want to is, what my suspicion is that, so near term, we can get a little retrace down to the 0.618 retrace of this wave here. But the real question is, what happens after, right? Are we going to head all the way down, or are we going to move higher? I think the fact we made an intraday high above this wave 1 high on the Jan 13th at 5%, has opened door for higher in both the bullish and the bearish scenarios. I do think we could have had an ABC correction here. And this is wave A, and this is wave B here, wave B low, and wave C can get all the way to 5.5 region. And that's just symmetrical to, so the wave of length, the wave C length is 100% extension wave A. So that's the lowest expectation of where the yields are heading in the medium term. And my main expectation is that potentially we've opened door to much higher. So if this is wave 1 and wave 2, we could have wave 3. Let me just show you. Moving all the way to 6%. That's the 1.236 extension of wave 1. So it's above where the wave C would typically trade, to 1.382 extension of wave 1, starting from the wave 2 low. So in either cases, yields are likely headed higher. It doesn't really fit with the recessionary scenario, because if in the case of recession, we would expect aggressive Fed cuts, and But the longer term yields do have a higher risk premium, a term premium that we've seen before versus the front end, like the 2 year. And what has been happening is the 2 year has been going down, but the 10 year and 30 year have been going up. The curve has been steepening. So this sort of curve steepening dynamic is what we need to watch, even if we're pricing in more cuts in the front end. So I'm expecting things moving high. So what could invalidate my view? I think invalidation would really come from first making a new low here below 4.3%. Then maybe this intraday high is a fake signal, head fake. But above this, staying above this, my primary expectations are essentially yields heading higher in the medium term. And for TLT, it's the same, but just the mirror image. We could get a move higher into the 90 region. Doesn't have to. There's no rule saying it has to. It's just kind of a typical place where we expect retraces to be. Sometimes they can be shallow. And then correspondingly, the wave C would be around the 100% extension of this wave here. Or in a more bearish scenario here, the wave 3 would be the 138% extension. So we're talking about the mid-70s. So I think the risk in the medium term is on the downside. Unfortunately, this is opposite of what I advocated at the beginning of the year, where I did believe that having bonds in the portfolio would at least serve as a diversification benefit. But to be honest, it depends on your time horizon as well. If you're a long-term bondholder, if you think about not actively trading bonds, but just picking up steady yields, that's around 4.5%, 5% for the next 10 years or plus. You should really lock in the bond yield at a place where you think is reasonable, where inflation, let's say, is 2.5% plus the real return of 2% a year. And that's a very comfortable place. And it's an opportunity that hasn't presented itself for a very long time as well. So we haven't seen this yield level in a long time. So if you're a very long-term investor, just want to lock in attractive real returns for the next 10 years and not worrying about the daily fluctuation of bond prices, I do think buying over here is probably reasonable anyway when it reaches 5%. And I would probably just hold as part of the portfolio for the long term. Whereas if your time horizon is very short, let's say just a couple of years, few months, I'll probably stay away from bond trading because the best you can do when the asset is going down is either your timing's immaculate, you stay in cash once dipping and buying back when it's bouncing back, and you can make some small gains of it. But it's just hard work compared to if you are picking a asset that's on the rise anyway and just either hold it or you can trade in and out depending on the expensive cheap levels. But you are going with the overall direction of moving up rather than trying to fight the current. So let's move on to Bitcoin. Right. So Bitcoin has been quietly bullish since the beginning of April. And I think it's been really under-talked because for a long time, everyone's been criticizing Bitcoin for dropping so much since January, while gold is moving up. And everyone's kind of dumping on Bitcoin. Oh, I thought you were a store of value. How about now? Yeah, gold is going up and you're going down with all the other risk assets. But actually, no one has really mentioned about the reversal of this this trend, a breakout of this bearish trend enough, I think. We've seen Bitcoin coming up from the lows, breaking above this trend line, and also moving up now towards my wave C target of wave B. And I think there could be resistance over here, given where the volumes be trading. So a lot of people bought in December and January, and also in November. on this hope of making past 120K, and they've been trapped since it broke below 95K. And if you look at this region here, that has been a generally supportive but now resistant region for Bitcoin. So I do think we will get some resistance over here at the 100% extension of this first rally. But if we can get above that, above 100K, I'm open to this not being a wave B, but actually the beginning of wave 5, where we have 1, 2, and wave 3, and 4, and 5 going higher all the way to, let's say, 120K. But until that, I'm marking this as a wave C or wave B. It's generally speaking, Bitcoin follows the global M2 money supply expansion with a 3-month lag. The money supply, let me just show you this chart here. So this is the chart we've been following. And so the G5 being US, China, EU, UK, and Japan. And that did bottom in January, right? It has been a very painful bottoming process over here, which impacted Bitcoin's price. But it has been going up since January and is making new highs. So, and Bitcoin has responded pretty quickly to this, to the end of this low as well, with a 3-month lag. So we might well be looking at wave 5 up, but I'm just cautious because the pattern, the structure of this fall was a bit larger than I previously expected. Therefore, this could be a wave B. But this relationship has so far held. So we just need to pay close attention to how Bitcoin reacts from here. So Apple, so our signals have shown Apple signal being 1 from the beginning of the week. And it has rallied. So it's pretty good news for us. The key question is now, we are right at this resistance trend line is not broken above yet. And this wave 2 retrace of 0.618 retrace, kind of what we typically expect in wave 2, wasn't really met. I think it kind of touched, but then rebounded straight away. So there is a chance we have A, B, C here, and for a deeper wave 2 in the coming week. And that will set us well for the wave 3 move up towards 250. But breaking above this trend line, then this April high would probably signal that actually wave 2 was just a shallow one at a 50% retrace, and we're ready to go for wave 3. Again, this region here above 220 and below 250, it is 200-day moving average and significant traded volume. People who bought in the back here from December to February, people were buying the dip. So I think here we could see a lot of supply being dumped onto the market, and therefore a lot of resistance. We haven't got that yet, so we'll pay attention day to day as we go. But here are the levels I think essentially will be key in Apple trying to break through. Amazon, again, we're under the trend line. The pre-market is pretty much unchanged overnight, even though I think after Google's results, it did do a small rally. But this is a difficult area, essentially. We got a lot of traded resistance here, just like what I talked about, what I said about Apple, and we have 200 MA at just at 199. We could have had a wave C here. It's just kind of like touching the 100% extension of wave A. It didn't really feel like a capitulation, but you could argue we had 2 gaps here. So maybe that was really the real capitulation. And if that is the case, if this is the true C, then we've had wave 1 and 2, which retrace 78% of this wave 1. And really the next target should be 210 to 215. So I'm open-minded to this fast, direct way up, but I'm just cautious that there will be resistance over here. If we get a retest up and the retest of this trend line, I do think it could be a good opportunity. But I think we just have to see as we go on how well Amazon breaks over this resistance area. Google, I think I just need to elaborate a bit more about this, the red line and the black line. So for me, the most obvious waves here is this being wave A, had a very small wave B bounce. A bit untypical, but okay, is possible. And then the wave C here. The alternative interpretation is that we've had 1, 2, 3, 4. And so this is actually wave 3 and 4, and we had wave 5 here. That could work, but my wave 2 is extremely shallow, and I wasn't too happy about that. Now, Google has broken above this trend line and almost break, and with the latest result being 4% after up pre-market and possibly opening at this level. It does look more like now we're traveling in the ABC pattern here after it's 5 waves down. And this ABC pattern would have resistance at the 100% to 123% extension of wave A, which is roughly around 170. So I'm just going to highlight it here. And I think that would be a quite difficult resistance break. But if we go above this, and this is a true low, we will have a new sort of chart layout, and we will reassess the situation. But I do expect this Google to turn down in this area and maybe get into a deeper wave C all the way down here in the 5-wave fashion as well. So as I said, this 2025 will be a rocky year for most of the Max 7s as investors debate about monetization versus investment, and whether it makes sense for them to spend so much money into a weakening economy, and they could get punished by China during the trade war. Meta, it does look like ABC correction here. I'm not really happy with this rebound here, and plus a new low. So my suspicion is that we could get a deeper wave C into this red box or even beyond. And it's also below this trend line here and below this 200-day EMA, as well as this really heavily traded area in the 600 region. So I think the near-term pressure still points towards down until Meta can prove otherwise, hopping over here and then towards our wave 5 targets in a more direct fashion. The positive thing is that we are seeing RSI divergence. What this means is that as the price made a new low, the relative strength actually improved. So that generally is a signal of a bottoming process, but it's not a reliable timing signal yet. So we just want to see how it trades below this trend line and whether we'll get one more low here or it will break above this region in a more direct fashion. Microsoft, I just want to talk about the wider structure first because it is quite different to the other stocks. So we already had between 2024 and today is a wave 4 retrace. It's a pretty long wave 4 retrace. We've had waves A into the August 5th territory unwind. Then we had a wave B into December. I was hopeful this could be a new wave 3 instead of wave B. It didn't make a new high, and now we've turned down to wave 4, which is a C wave with 5-wave subwaves. My primary expectation is that wave C is done. We have enough magnitude in this move to suggest it's done. And therefore, we are seeing a 1-2 setup, and breaking above this is decidedly bullish towards this wave 3. Just like all the other Max 7 stocks, we have a significant resistance area here with heavily traded volume being built up over here. At the high level, they might want to get out at break even, and we also have the 200 MA around the 415 level. But generally speaking, if we get a push up into the screen box and retest, I think that could be a trade setup opportunity. And then wave 3 would be something like 400, 430 to 440 area. So we're just going to watch how well Microsoft breaks over this trend line. If it fails to break over and turns down again, it could be that we've had a 1, 2, and actually this is wave 3, wave 4, and the new low, wave 5. That'll be pretty bearish. It's not my primary expectation, but we must be open-minded to that possibility. So I'm just going to draw it out here. 1, 2, 3, 4, 5. And obviously, if we get over this wave 1 or even this wave 4 high, it's just getting over 400 generally, this red, we can remove this red alternative expectation. NVDA. NVDA retraced into our wave 2 expectation at 0.618 to 0.786, retrace of wave 1. A turn down from this near-term trend line, so not decidedly bullish yet. And then there's a higher trend line waiting ahead with this heavily traded volume, as well as 200 MA over here. So NVIDIA has a lot of hurdles to overcome before it can reach wave 3. Personally, I don't think AI story is done because we still need, I think we're still many years away from having the true AI application stage where we're really using AI in everyday applications like we had all those new apps on the App Store, essentially. So today, how many AI apps are there? And they're mostly based on the large language models and photo creation models. But if you think about when we first had the weather app or Doodle Jump, the game, etc., to where we are now on the App Store with millions of new apps created every day. I even created one myself last year. I think we still have a long way to go, essentially. And that it should be bullish for NVIDIA. And I guess the question is, first, the pricing, the cost of inference versus pre-training, is it going lower? Is it higher? Obviously, NVIDIA thinks the cost of inference is 100 times more intensive than pre-training, but obviously he's the seller, so he's incentivized to do that, to say that. But I do think there's still a lot more capex to be spent for this AI cycle. And I don't think Max 7s are wrong because but investors just don't really know how to value it right now. And finally, for Tesla, I think it's just peaking above our trend line here. So that's pretty bullish. Our signal is back on for end of the day higher today. And there has been a lot of accumulation in this zone here. So that helps us taking off towards this target. I have put this as a wave B target for now because of the structure of this decline in 5 waves. I have now marked this wave 5 as ending as we are breaking above this trend line. And I just want to show you the other chart for Tesla, very similar to Bitcoin. Following the global M2 money supply expansion, it should help. We should have seen the bottom and now moving along in a more bullish path with the G5 M2. So my expectation is now we've probably bottomed. This is a very short wave 5, but it does happen. Now we're moving towards this, for now, wave B expectation above 400. There's a lot of traded volume in this region, so Tesla will get a test here. And also there's the 200-day moving average here. So near term, challenging this moving average and then getting towards 400 is the job at hand. The catalyst could be the robotaxi rollout. I think it's a very low bar because the Model Ys are essentially capable of full self-driving, and the rollout, the initial rollout, could just be limited to a small fleet of testing. It's a tick box exercise essentially for Elon Musk at this stage. the question is, okay, so when can the wider pool of Tesla owners and customers actually access this platform and start using it like Uber and start making money from it? Elon Musk actually puts the timeline to 2026. Of course, we don't really know until they've at least rolled out and seen some initial results yet. Tesla is very much a beast of liquidity, opportunistic trading, and technical trading, crowd psychology, and sentiment drivers. So I would really, as an investor or trader, I would really try to detach all these car sales numbers, fundamentals from where the stock from. The stock in this sense really isn't the business, the current business at least. It is the overall beast of future expectation of this trillion-dollar robot taxi market and the Optimus humanoid robot market. And that is purely sentiment driven than fundamentals driven for now. So thank you very much. Any questions, please, you can leave a comment or ask me in Slack.